Imagine this. You wake up one morning, check your phone, and realize that while you were sleeping, your money grew. Not because you worked overtime, not because you hustled another side gig, but because your investments were working for you. That's the magic of the stock market. But let's be real for a second. If you're new to this world, the stock market can feel intimidating. It's like walking into a room where everyone speaks a different language, P/E ratios, ETFs, dividends, IPOs. It can feel overwhelming. Here's the truth. You don't need to be a Wall Street genius to start investing. In fact, some of the wealthiest people in the world started small. Backhand index pointing right thing about Warren Buffett, the man often called the Oracle of Omaha. He didn't start with millions. At just 11 years old, he bought his first stock, just 3 shares of City Service Preferred, using money he saved from his newspaper route. Today, he's worth over $100 billion. Now, I'm not saying you'll become the next Buffett overnight, but I want you to understand this. If you start investing wisely, even as a beginner, your future self will thank you. And in this video, I'm going to break down, step by step, how you can start investing in the stock market with confidence, even if you're starting with just $50. So stick around, because by the end of this video, you'll have not just a knowledge, but a clear action plan you can use to start your investing journey today. Okay, let's start with the most important question. Why should you even care about the stock market? After all, you might be thinking, I already have a job, I'm trying to pay bills, save for rent, maybe even clear debt. Why add stocks into the mix? Well, here's the truth. Your job alone will never make you wealthy. Let me tell you a quick story. A friend of mine, let's call him Mike, worked as a manager at a retail store for almost 20 years. He was good at saving. He had about $15,000 in his savings account. But here's the problem. Every year inflation was eating away at his money. You know that coffee that used to cost $2 5 years ago? Now it's $4. Gas, groceries, rent, they keep rising. That's inflation. While Mike's $15,000 sat in his bank account earning maybe 0.05% interest, inflation was around 3 to 4%. In other words, he was losing money by saving. Now let's compare that to someone else I know, Sarah. She's a nurse, not a finance expert, but she started investing in the stock market 10 years ago. She consistently put aside $200 a month into an S&P 500 index fund. That's it. No fancy trading, no complicated charts. Just steady investing. Today, that $200 per month has grown into over $40,000. And she didn't have to work extra hours for it. Backhand index pointing right. That's why investing matters. Here are 3 big reasons why you should invest in the stock market. 1. Beat inflation. Money sitting in a bank account is losing value every year. Investing allows your money to grow faster than inflation. 2. Build wealth over time. The stock market has historically returned about 10% per year on average. That means if you invest $1,000 today, in 30 years it could grow to almost $17,000 without you doing anything extra. 3. Financial freedom. At the end of the day, investing isn't just about money. It's about freedom. It's about being able to say, I don't have to stress about bills. I don't have to work until I'm 70. I can live life on my terms. Let me give you one more powerful example. If you had invested just $1,000 in Amazon back in 1997, when it first went public, today it would be worth over $1.5 million. Of course, not every stock will be the next Amazon. But the point is, the earlier you start, the more opportunities you give your money to grow. So if you're watching this and you've been waiting for the right time to invest, listen closely. The best time to invest was yesterday. The second best time is today. All right, now that we understand why investing is important, let's get into the meat of it. What exactly is the stock market, and how does it work? A lot of beginners hear stock market and immediately think of something super complicated, filled with men in suits yelling on Wall Street. But I promise you, it's a lot simpler than it seems. Think of the stock market as a giant marketplace, just like Amazon or Walmart. But instead of buying clothes, food, or electronics, people are buying and selling pieces of companies. Small Blue Diamond, what is a stock? A stock is simply a tiny piece of ownership in a company. When you buy a stock, you're not just throwing money into the air. You're literally becoming a part owner of that company. Backhand index point right example. Let's say you buy 1 share of Apple. Congratulations, you now own a small piece of Apple. You don't get to walk into Apple's headquarters and tell Tim Cook what to do. I wish faced with tears of joy. But you do benefit if Apple does well. If Apple's profits go up and their stock price rises, the value of your shares increases too. That's how people grow wealth, by owning companies that grow over time. Small blue diamond, what is the stock market? The stock market is a place where all this buying and selling happens. In the U.S., we mainly have 2 big markets. NYSE, New York Stock Exchange. The big one in New York City where companies like Coca-Cola, Walmart, and Disney are listed. NASDAQ. This is where most tech giants like Apple, Amazon, Tesla, and Microsoft are listed. Think of them like different malls. You can shop in either one, but the stores, companies are slightly different. Small blue diamond, how do stocks make you money? There are 2 main ways you make money in the stock market. Stock price growth, capital gains. Example. If you buy a share of Tesla for $100 and later the price goes up to $150, you just made $50 profit. Dividends, cash payments. Some companies, like Coca-Cola and Johnson & Johnson, pay out a portion of their profits to shareholders every quarter. That means if you own their stock, you actually get cash deposited into your account just for being an owner. It's like renting out a house. You make money if the value of the house goes up, and you also get rental income. Small blue diamond stocks versus bonds versus ETFs. Here's where beginners often get confused. So let's clear this up in plain English. Stocks equals you own part of a company. High risk, high reward. Bonds equals you lend money to a company or the government, and they pay you back with interest. Safer, but usually lower returns. Backhand index point right example. Buying a U.S. Treasury bond is like loaning money to Uncle Sam. You'll get it back, plus a little interest. ETFs, exchange-traded funds, equals imagine a basket filled with many different stocks. When you buy one ETF, you're investing in dozens or even hundreds of companies at once. Backhand index point right example. The S&P 500 ETF owns the 500 largest U.S. companies. So instead of betting on just one company, you're betting on the whole U.S. economy. ETFs are great for beginners because they reduce risk. If one company does badly, the others in the basket can balance it out. Small blue diamond, the magic of compounding. Now, let's talk about something powerful. Compound growth. Albert Einstein once called compound interest the 8th wonder of the world. Here's what it means. When you invest money, it earns returns. Those returns then earn more returns. Over time, your money starts growing like a snowball rolling down a hill, getting bigger and bigger. Backhand index point right example. Let's say you invest $200 per month in an S&P 500 ETF that grows at an average of 10% per year. After 10 years, you'll have about $38,000. After 20 years, you'll have about $137,000. After 30 years, you'll have nearly $379,000. And here's the kicker. You only contributed $72,000 of your own money over those 30 years. The rest, over $300,000, was growth from compounding. That's why starting early is so important. Time is your best friend in investing. Small blue diamond story to drive it home. Let me tell you a quick story about 2 friends, Jake and Emily. Jake starts investing $200 a month at age 25. Emily says, "I'll wait until I'm more stable." She doesn't start until age 35. Both stop investing at 65. Jake, who invested for 40 years, ends up with around $1 million. Emily, who invested for 30 years, ends up with around $500,000. Here's the shocking part. Jake only invested $24,000 more than Emily, but he finished with double the money. Why? Because of the magic of compounding over time. White every check mark. So to recap Chapter 3, a stock equals ownership in a company. The stock market equals a place where stocks are bought and sold. You make money through price growth and dividends. ETFs are safer for beginners. And the sooner you start, the more you benefit from compounding. Clapperboard. Closing hook for Chapter 3. Now you might be asking yourself, okay, I get the basics, but how do I actually start investing? What apps or platforms should I use? How much money do I need? Don't worry, because in the next chapter, I'm going to give you a step-by-step beginner's guide to buying your very first stock or ETF. And I'll even show you how to do it with as little as $50.